Hey there, property owners. Welcome back to another Reliable Accountants educational web series video where I help you navigate the tricky waters of rental property management. Today, I'm diving into a hot topic, understanding the difference between repairs and capital improvements for your rental properties and how they impact your taxes. Now, if you're in Australia, this is especially important because it determines how you can deduct these expenses on your tax return. So, let's break it down based on guidelines from the Australian Taxation Office, or ATO for short. First up, we've got repairs and maintenance. These are the costs you incur to restore your property to its original condition, addressing wear and tear or damage. The great news is that these costs are immediately deductible in the income year they are incurred. Let me give you a few examples. Say you have a leaking tap and you get a plumber to fix it. That's a repair. Or imagine part of your fence is damaged and you replace just that section. Again, that's a repair. Even repainting your rental property to maintain its appearance due to wear is considered a repair. Now, let's talk about capital improvements. These are expenses that enhance your property beyond its original state, providing greater efficiency or extending its useful life. Unlike repairs, these costs are capital in nature and not immediately deductible. Instead, you claim them over time through capital works deductions or depreciation. For instance, if you decide to replace your entire fence with a brand new one, that's a capital improvement. Adding a room or extension, also a capital improvement. Upgrading old fixtures to modern high-end alternatives. Yep, that's another capital improvement. Let's go through some practical examples. Suppose a section of your rental property's roof is leaking due to storm damage and you repair it. This is a repair and the expense is immediately deductible. But if you replace the entire roof because it's old, that's a capital improvement, and you'll need to claim it over time. Or imagine a tenant breaks a window and you replace the glass. That's a repair and it's immediately deductible. But if you decide to upgrade all your single-pane windows to double-glazed ones for better energy efficiency, that's a capital improvement. You'll claim that over time through depreciation. Here's a few key considerations. Initial repairs made to fix defects or damage existing at the time of property acquisition are capital costs and not immediately deductible. If an expense includes both repair and improvement elements, you may need to apportion the costs between deductible repairs and capital improvements. Always maintain detailed records and receipts of all expenses to substantiate your claims. For comprehensive information, refer to the ATO's guidelines on rental expenses you can claim now. Understanding the distinction between repairs and capital improvements ensures accurate tax reporting and maximizes your allowable deductions. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe for more property tips. For any tax-related inquiries, contact Reliable Melbourne Accountants at 1300049534 or email us at inquiry@rmelbourneaccountants.com.au.